Good afternoon, thanks for joining us on 𝐊𝐶𝐞 TV. James Preston with you for News Beyond the Markets, a special show that takes a look at some of the top stories domestically and abroad that could have the ability to impact markets and investors. In this edition of News Beyond Markets, I'll shine the spotlight on domestic tourism, COVID-19, a sports star who's impacted the market and a whole lot more. But first up on News Beyond the Markets is an update coming in for the Australian banking sector. Australia's banking watchdog has asked the country's big banks to give assurances that they are lending responsibly and managing risk in their home loan books amid skyrocketing house prices and signs of increased risky lending. The Council of Financial Regulators also warned that it was discussing, quote, policy options that could be used to address risk if growth in household debt substantially outpaced the income. The Australian Prudential Regulation Authority, also known as APRA, was keeping a close watch on banks' lending standards. APRA forms the council alongside the Department of the Treasury, the Reserve Bank of Australia and the corporate regulator. Household debt in Australia, where wage growth has remained stubbornly low, is already one of the highest in the world at over 180% of income and over 120% of GDP. Near zero interest rates, a relaxing of prudential oversight over the past few years, and an enormous monetary expansion in the wake of the COVID-19 pandemic have already pushed house prices in capital cities to about 10% above their previous 2017 peaks. The council said, however, that overall lending standards in Australia were still sound and highlighted it was important that they remain so. Moving on from banking and across to tourism, a surge in domestic tourism as a result of increased consumer confidence, lower airfares and greater competition between airlines has helped drive the recovery of Australia's airline industry in the recent months. This was revealed in the ACCC's fourth airline competition in Australia report. The report released today shows total passenger numbers in March 2021 were 55% of pre-pandemic numbers, which is up from 41% in December 2020. The airlines have reported continued growth since March 2021 and had forecast a return to pre-pandemic levels of flying early in the second half of 2021. However, recent outbreaks and subsequent border closures are likely to delay this timeframe. The Australian Government's Tourism Aviation Network Support Program has announced in March that it subsidised 800,000 half-price tickets to 15 destinations, and it hoped to stimulate demand for holiday travel. While the TANS program only applied to certain routes, Qantas, Jetstar, Virgin and Rex ran a number of overlapping promotions at the same time to try and encourage more people to fly. ACCC Chairman Rod Sims said that prior to the recent Victorian outbreaks, the domestic airline industry had experienced relatively fewer and less significant disruptions for a number of months, and the combination of cheaper airfares and growing consumer confidence to travel interstate was critical to the recovery. While airline expectations may have been downgraded since the Victorian lockdown from late May, the Qantas Group had previously forecast capacity would reach 95% of pre-pandemic levels by early June 2021, with both Qantas and Jetstar expected to exceed 100% in 2021 and 2022. Virgin had forecast that its capacity would reach 85% of pre-pandemic levels by mid-June 2021. Rex has expanded its capital city reach, and from next week it'll begin operating 6 routes connecting Sydney, Melbourne, the Gold Coast, Adelaide and Canberra. In response to Rex's promotional entry airfares across the new routes, Qantas, Jetstar and Virgin have also been running competitive sales that have put downward pressure on prices. Consumers flying Sydney to Canberra may benefit the most, as Qantas had been the only operator on the route since Virgin withdrew its service in March 2020. Growing competition on capital city routes means more passengers have more choice. Based on March 2021 figures, 18% of Australian domestic passengers flew on routes where there was a choice of 3 airline groups, compared to the pre-pandemic figure of just 1.5%. This number is expected to have increased since March, as Rex has now launched even more services. Well, on that note, it's time for a very short break. Stay tuned as I'll be back with more updates on Australia's airline industry in just a moment on 𝐊𝐶𝐞 TV.
At 𝐊𝐶𝐞 TV, we'll take you to the heart of the Australian equity market. We'll bring you breakthrough stories that highlight volatility, as well as tailwinds building across the length and breadth of markets. Whether space travel will gain momentum, while economies may gradually open amid vaccine rollouts. Our experts will share their timely inputs. So join us on this exciting journey of live streaming, financial and stock market news. 𝐊𝐚𝐥𝐤𝐢𝐧𝐞 TV.
Thanks for sticking with us on 𝐊𝐚₥ TV. Great to have your company for the News Beyond Markets show. I'm James Preston, and before the break we were discussing a surge in domestic tourism and how airlines are managing the trend. So let's continue on that trend ourselves. Well, passengers flying between Melbourne and Gold Coast, Melbourne and Adelaide, and Sydney and Gold Coast now have a choice of 4 airlines, as Qantas, Jetstar, Virgin and Rex are all operating on the same routes. Rex has publicly raised concerns that its rivals have been increasing capacity beyond passenger demand. The ACCC is assessing the impact on competition of expanding capacity and discounting airfares on certain routes. The ACCC has also revealed it has the option of recommending policy action by the government to address any competition concerns. The report shows that the Qantas Group's share of total domestic passengers fell slightly to 69% in March 2021, down from 74% in December 2020, but still remains higher than its pre-pandemic share of 61%. Meanwhile, Virgin's passenger share recovered to 28% in March 2021, up from 24% in December 2020, while Rex has maintained its 2% share. Moving on to the next piece of important news on News Beyond Markets, the Therapeutic Goods Administration, also known as the TGA, national boards and the Australian Health Practitioner Regulation Agency support vaccination as a crucial part of the public health response to the COVID-19 pandemic. Recent TGA regulatory changes regarding the promotion of approved COVID-19 vaccines clarify the way healthcare professionals can communicate to the public about COVID-19 vaccines and gives greater flexibility to openly discuss vaccination. On the 7th of June 2021, the TGA issued updated guidance on the lawful communication and promotion of COVID-19 vaccines, which explain these changes. A number of healthcare professionals and their peak bodies have asked for clarification about the relationship between these changes and the responsibilities that registered health practitioners and others who advertise regulated health services have under the national law. Not all statements about COVID-19 vaccines will involve advertising of regulated health services. Where promoting COVID-19 vaccines does involve advertising of regulated health services, it must comply with both the TGA's guidance and advertising requirements of the national law. The updated TGA regulations and guidance permits healthcare practitioners and others to develop their own materials to communicate publicly about COVID-19 vaccines within particular bounds. The TGA's guidance states that the materials must not make statements that are misleading or deceptive, claim that vaccination is totally safe, or compare the different types of COVID-19 vaccines. While more specific, this is consistent with the National Board's advertising guidelines and position statement on COVID-19 vaccination. Soccer stars are typically kicking goals, but on this occasion the shares of a major soft drinks provider have copped a kicking from one of the world's most famous athletes. All the details in just a moment on 𝐊𝐚₥ TV.
The market takes the weekend off, but your money won't. Get a comprehensive update on the ASX listed stocks and market trends. Watch the experts touch upon the fundamental and technical developments and trending strategies in the equity space. We will be your daily guide as you explore the Australian share market, be it global vaccine developments or China's trade relations or global political turmoil or economic revival prospects. We will bring you live updates driving the equity market trends. 𝐊𝐚₥ TV.
Hi, welcome back. James Preston with you on News Beyond the Markets here on 𝐊𝐚₥ TV. And before the break, we were discussing the latest updates on COVID-19 vaccines. But let's turn our attention now to sports stars, and typically, sports stars and endorsement deals typically go hand in hand, and it can be a lucrative partnership for both parties. But what happens when a famous athlete acts negatively toward a brand? Coca-Cola have found out the hard way courtesy of soccer superstar Cristiano Ronaldo. The Portuguese prodigy accidentally caused Coca-Cola shares to drop 1.6%, equating to a staggering $5.2 billion dip during a press conference to promote Portugal's Euro 2020 fixture against Hungary. He pushed away 2 bottles of Coca-Cola and replaced them with a bottle of water, outlining his contempt for the soda. For the record, Portugal went on to win the match 3-0, proving that he's probably on the money with his water preference. There is, however, some controversy around Cristiano Ronaldo now emerging, as images have been released of him endorsing the soft drink company in a 2006 World Cup campaign. And despite his claims of treating his body as a temple, he also filmed a 2013 KFC commercial for the Middle Eastern market. Fair to say, that does not look finger-licking good on his part. From a soccer superstar to an eccentric billionaire, and Elon Musk is once again in the news. Last May, he announced that he was planning to sell all of his possessions and own no house. Fast forward 13 months and he has now listed the last of his properties, his California Bay Area mansion, which has been placed on the market for $37.5 million. Musk has already sold 6 other properties since last May, in addition to a property in 2019, for a total of $114 million. Part of his decision to sell his property and possessions is owing to the increased social pressure billionaires have faced, and Musk is trying to curb that particular piece of enthusiasm from activists. Continuing in the property space, and the New South Wales and federal government has conceded that the City of Sydney is facing a housing supply crisis. The average price of a home in the city now sits at an incredible $1.3 million, and even dilapidated units close to the CBD, which require hundreds of thousands of dollars worth of work, have fetched prices well over $1 million. The coalition government is attempting to get on the front foot and is working with developers to provide 18,000 new homes in southwest Sydney, but the end result will still be several years away. Plans to address negative gearing concerns are for the moment on the back burner, which could mean more hardship in the years to come for those looking to finally enter the property market. All right then, well that is all for now for News Beyond Markets. Stay tuned to 𝐊𝐶 TV though for more live updates. We'll be back with more news on markets, economy and diverse themes and sectors on 𝐊𝐶 TV. I'm James Preston, signing off.